Good evening and welcome to Money Matters. My name is Pat Welde with Merrill Lynch. My co-host this evening is Mr. Richard Sichel, the Chief Investment Officer of Philadelphia Trust Company. Richard, how are you?
Nice to be here again.
Good to be with you. I want to alert our viewers that we do have a truly special guest this evening. We have with us, and they'll be joining us very shortly, Mr. John Bogle, who is the founder of a very large local company, the Vanguard Group. So please stay tuned. He'll be with us very shortly. Richard, how's things in your world?
Okay. The clients are relatively happy, and we tend to be a growth at a reasonable price type of firm. So we look at the growth, we look at what we want to pay for that growth, and
right.
We try to find some value in the good markets and sideways markets as we are having the first couple months of the year, right?
And with that being, what you're looking for and what you're trying to deliver, where are some places that you're finding value? The sectors or parts of the investment world?
Yeah, I mean industrials, Raytheon, United Technologies, companies like that sort of grow with the country, grow with the world.
Right.
Not overly priced at this point. There are actually some tech companies that have been ignored to some extent. Teradata, which is a data warehousing company. Anything but nothing like the dot-com times when they were 100 times the earnings, or they had no earnings. These companies have real earnings.
Real earnings, and how about the phenomenon with some of the real large mega tech companies now becoming pretty good total return stories with
Apple with the dividend
and
growing dividend
and Intel,
sure
things like that. It's a real change in dynamics, isn't it?
Right. It is, and some people think that that's a signal that these companies have run out of steam, but we don't think so. We don't mind going with them, and if they want to buy shares back, they want to pay bigger dividends or initiate dividends, it's fine with us. We'll give them time and let them grow.
Excellent. Well, I want to spend plenty of time with our special guests, as I know you do as well.
Definitely. But
I have a viewer question. Can you entertain a viewer question?
I will do my best.
A question from Jack Harper from Willow Grove, who asks, what are some possible changes in the mutual fund investment area for the near future?
We have the expert over here who probably would like to answer that question. So, I defer to you. Is there a bigger expert?
What do you see, Mr. Bogle?
The mutual fund industry is already changing. It just doesn't know it.
Right.
Indexing has taken over the industry in a very important way. About a third of all equity fund assets and over 100% of the cash flow that goes into mutual funds is going into passively managed or unmanaged index funds based on things like the Standard & Poor's 500 index and the total stock market index, and to some smaller degree, the total bond market index, and to actually a little bit larger degree than that, to the international index and the emerging markets index. So that's where the growth of the industry is coming from, and I don't see it stopping.
Right.
It's about a third of mutual fund assets now, indexing is, and I don't think it's going to slow down. It's growing even faster than that.
Right.
Indeed, Vanguard did 100% of the industry's cash flow in the first quarter of this year. Somebody got to notice this somewhere besides me.
Yeah. Well, Mr. Harper, hopefully that answers your question satisfactorily. For the other viewers out there, we always invite your questions. You can please mail them to us. You can send questions to Money Matters, 205 East Levering Mill Road, Ballackinwood, PA 19004, and you can also email questions to us, moneymatterstv, all one word, @gmail.com. So we do look forward to your questions. Please bring them, and we'll try to get you answers like we just received. Well, now I want to actually formally introduce our guest, who truly is an icon in the investment world. Mr. John Bogle is the founder of the Vanguard Group, 1974. And the company is just truly, it's amazing the growth that they've experienced through the early leadership of Mr. Bogle and passing on that to others since his retirement formally from the company, although he's still very active with it. He's an author. He's the inventor of the first index fund. I have 2 pages of accomplishments, but I'll let you speak to them yourself. Welcome to the show.
Thank you very much. Good to be with you, both of you.
I really would like to talk to you about just how proud you are of what you've built. I know it's been it wasn't always what it is today, and it was your your skill and expertise that said, I have an idea and I want to develop it, and it's just been phenomenal.
Well, I'm mindful of the Bible's warning that pride goeth before a fall. And actually, I'm still very busy, even at my stage of life, and I've never really had time to sit back and think you've accomplished A, B, or C. I have a quote in my book called Enough at the end from Sophocles, I think, that says one must wait until the evening to enjoy the splendor of the day. And my evening isn't here yet. So once the time comes, the evening comes, perhaps I will enjoy the splendor of the day. But I doubt it, because I'm just not that type. Do what you can
not
every
in your
day.
makeup.
Right. And from what I know, started out, worked hard. Everything did not exactly fall into place perfectly. And maybe you could give us a few minutes on that, of just how you scrambled and redid and became so successful.
Well, I'll tell you a funny anecdote about that. I ran into this man, friend of mine, who is a stockbroker here in Philadelphia, or was then, and I told him what we were planning to do. This is back in 1974. Mm-hmm. What our plan was. I'd been fired from Wellington Management Company, this new company called Vanguard, and he said, how are you going to make it all work? And I said, well, we're going to do a bunch of things. First, we're going to create a mutual company focused on making money for the stockholders and not for the managers. And he says, I think you're in trouble. And then I said, and then we're going to start the world's first index fund. He said, what's that? I said, well, that's a fund that doesn't have any management. It just follows the Standard & Poor's 500 index.
Right.
And he said, I think you're in deep trouble now.
Better rethink that.
And I said, and there is one more thing we're going to do. We're going to eliminate our entire distribution force, brokers selling our funds all over the United States, and go no load, appeal directly to the consumer. And he said, oh my God, you're never going to get anywhere. So that explains it, most of it. And nobody quite understood what a mutual company was about. They're very common in the savings area, reasonably common in the life insurance, mutual life insurance company area, but never been tried in the mutual fund industry. But it makes a lot of just mathematical sense. The returns go to the consumer, of all things.
Imagine
Why would you want to do that? So I knew we had it right, and yet the real criticism came with the index fund. And there was a great posters issued all over Wall Street, like so by so. Mm-hmm. And there was Uncle Sam with a cancellation stamp on it saying XXX. He was stamping stock certificates like that, saying stamp out index funds. Index funds are un-American.
Wow.
It was not much of an idea.
Right.
It was called Bogle's Folly. That's the only actual repeatable phrase I could describe, repeatable over the television.
This was in
there.
1975, is that correct, when you founded the fund?
The Vanguard 74 index fund started in 75 and underwritten in 76.
Okay.
And the underwriters, we had the four biggest retail underwriters in Wall Street, and not Merrill Lynch. They didn't do that kind of thing then. Mm-hmm. But, Reynolds and Company, these names won't mean much to anybody, but was among them, Payne Weber, Dean Witter, and they thought they could do $150 million underwriting, almost a record-size underwriting for those days, and in those dog days. They brought in $11 million. And I said, oh my God, we can't even buy all 500 stocks in the index in round lots. And they said, why don't you pull the offering? Just give everybody their money back. And I said, don't you understand? We have the world's first index fund. We'll make it work. And we did. Didn't go anywhere for many years, really until the middle 90s before it got going.
Even throughout the 80s, you didn't see real meaningful
very
growth?
Slow going, very slow going. Right. It was so slow, I got in a little criticism for this, like almost everything else I've done, that to get the fund's assets up to $100 million, we merged another Vanguard fund into it, a $50 million fund. And then people say you're trying to pull your chestnuts out of the fire. And I suppose there was some truth to that, but it seemed like the right thing to do, because these are funds that had to require tax efficiency, which is one thing everybody agrees the index funds do.
Sure.
So, actually, to make that even more dramatic, this great idea that's dominating the industry and the world really today of indexing. We started the fund it was underwritten in 1976, First Index Investment Trust it's called. It's now called Vanguard 500. Mm-hmm. And it was just so difficult to get anybody's attention. And in the mutual fund industry, this is a great copycat industry. You file a fund down with the SEC,
right. And
sometimes people file their funds almost before yours gets there, and because everybody knows the idea. Nothing. It was 8 years later, 1984, before the second
no
index
competition
fund.
for 8 years. And,
but
and as you're saying, no interest. No interest.
Nothing. Nothing.
The business didn't flow in right away.
So it was off to a bad start, and it says something about being patient, mm-hmm. Not my strong point, and being determined. Mm-hmm. But it's actually easier than that. You have the math on your side, and you know it will work. It's not a question of guessing or projecting or speculating. As long as you can offer the stock market return minus a tiny amount of money, in those days probably 40 basis points, you're going to outperform the rest of the industry, which is also going to get the market return because the average fund is average. And right. Only they're going to charge you a couple of hundred, 250 maybe in those days, 250 basis points. So you're going to win by over 2% a year, right. And it's only a matter of time. It's not a matter of chance because the math is the math. Gross return in the stock market minus cost equals net return. That's really complicated, isn't it? I should have patented the idea, like the Coca-Cola formula or something. But everybody knew what the formula was. They may not have looked at it quite that way. So here we are in an industry where it turns out cost is everything,
right.
With no one wanting to compete with us on cost. And to this day, nobody wants to compete with us on cost. In fact,
they're making too much money.
They're making too much money, and they start their index funds, and they have to compete. And you can't. Well, actually, some firms, I won't get into this now, charge a 5 or 6% sales charge and 1% a year for an index fund. And believe it or not, they do that without going to jail. Yeah. I mean, these are commodities, pure commodities. Mm-hmm. But if you think about it, the market itself is a commodity. You own the market, and the index fund is just a slice of that, and it will give you, guaranteed really, the market return. So it's a very simple thing to do, and if you combine simplicity of the index fund with the thrift involved in the mutual structure, you're going to win. And so now we're the largest firm in the world, largest investment firm in the world.
Let me shift gears because that's all about mutual funds, which is truly, just been, astounding the growth. But what's astounding me right now, as our viewers watch this program, is the dollar growth that we're seeing in the exchange traded fund world, ETF world, which I know Vanguard is a very big piece of that. Can you help the viewers out there, maybe understand the difference between an exchange traded fund and your index mutual funds, and is there one better than the other, or are they different to a degree?
Well, let me explain the difference.
Yeah. Exchange
traded funds are all index funds. So if you look at an exchange traded S&P 500 Standard & Poor's index the Standard & Poor's 500 on an ETF basis, it's going to look exactly like the standard. I had to give an acronym for them. Instead of ETF, I have TIFs, traditional index funds. And they will have, in Vanguard's case, it's the same stock portfolio.
Okay.
One of them is for long-term investors, and the other, using the original slogan of the ETF, you can trade it all day long in real time. And honestly, Pat, I'd say, what kind of a nut would want to do that? Why?
Why is that a good thing?
So I look at this great advantage as, in fact, a great disadvantage. Because people are emotional, investors are emotional.
Right.
If we get a big plunge, as in the flash crash back in May of, I guess, 2003 or 2005, 2010, excuse me, and you look at that, and when the market plummeted in the middle of the day because of a whole lot of technical factors,
right.
The ETFs were the most adversely affected. 83% of the stocks were trading just dried up and ceased was in the ETFs.
Yeah.
So people that got out of them had the greatest opportunity to lose money ever given to a man or woman, if they want that. And usually that's not what they want.
Yeah. I mean, I personally have seen that, the ETF has become so big and so powerful. I think, quite frankly, it's very disruptive to the market. And Rich, you may see it on a daily basis in what it does in different sectors of the stock market. Like, I mean, one biotech company, just one company, announces something maybe not terrific or bad, and every biotech stock goes down, and people scratch their head and say, well, my company's doing great. Why is mine going down? And I'm telling you, it's because the ETFs, they're hitting the sell button, and they're selling the biotech ETF, and all the stocks are going down.
Well, what people don't understand about these exchange-traded funds or ETFs is about half or maybe even 55 or 60% are owned by financial institutions, big financial institutions, and they may be short, they may be long, they may be hedging another position, they may be doing anything, and the trading volumes are astounding. The original SPDR, Standard & Poor's first ETF fund, which is the biggest of all ETFs, around 160 billion of assets, is the most widely traded stock in the world every single day, that ETF. And it turns over at about 7,000% a year. And I'm the kind of guy that thinks turnover of 5% is sort of pushing the envelope.
It's a little crazy. Yeah.
Yeah, really, it's a trading frenzy with the ETFs. They create that. And then you have, the traders who are trading in milliseconds and all that. I mean, and then, we look at your books.
Nanoseconds.
Nanosecond, yeah,
that's
yeah.
old-fashioned.
That
man.
was
it's too
that's
slow.
so whatever
That's too
from years
slow.
ago. And then your books, the things that you say, I think are just can help calm markets. There's too much news being thrown at everyone. The 24/7. When I was first in the business, I would have clients call me during the day and say, "What's the market doing?" Yeah,
Right.
They know They know around the clock what the market's doing. It makes them nervous on many occasions, and might make them be traders when they should be investors. And I think your influence, the words in your books and everything is sort of be long term. Don't try to time the market. And I just think that it's just a plus for the market that people listen to you.
Well, let's see if I can explain it this way. We're so focused on the markets, which jump around for one reason or another, sometimes because they should and sometimes because they shouldn't. It's often speculators trying to guess what other speculators are going to do.
Guessing. What's he thinking?
What's the point really of all this? Because in the long run, the movements of the market account for 0% of the return on stocks. It's what corporate America produces, and that's the current dividend yield if you're investing today, and the subsequent earnings growth. And that's going to tell you what we call the investment return on stocks. It's not generated by the stock market. The stock market is a derivative of the value created by those corporations. So it's foolish to even look at it. Now, we can't break ourselves of the habit. It's fun. Yeah. It's like going to the casino, and you're guaranteed to lose if you play it long enough and heavy enough. And, I've said in one of my books, I think it was a pretty good expression, by the way, the stock market is a giant distraction to the business of investing. I mean, when the stocks go down 250 points, what did the value of corporate America do today?
Right.
Well, the dividend remained pretty much unchanged. The potential earnings growth was certainly the same as it was at the end of the day as it was at the beginning of the day. Yeah. So the basically investment return has been unaffected. And so every once in a while, you'll get way out of line, and investment return will be over expectations will be too large. Yeah. But if you think about, let's say that the normal long-term growth rate of corporate America has been about 5%, and the long-term growth rate of our gross domestic product of the economy has been about 5%, and growth in corporate earnings has been about 5%. Nominal before inflation, and the dividend yield is now at 2%, you should be thinking about a 7% return, because today is a little funny time. I think it's a risky time, but the price earnings multiples and the change in that multiple. In other words, take a simple example: if the price earnings ratio of a stock, the price you pay for $1 of earnings, goes from 10 to 20, $10 for $1 of earnings, $20, the stock goes up 100%. The market goes up 100%.
Right.
But it comes back to zero. And if you look at the 100-year history of the United States, 120, 1875, wherever you want to start it, that speculative return, change in the PE, is a line like this, and the investment return is a line like this. So what are you paying attention to this foolishness for? That's what I would ask investors. And, it somehow is inbred for us. It's competitive. We're this great competitive nation. We got to do better than each other, knowing that we're no Lake Wobegon here. All the investors, on average, are not above average. You heard it here.
Right, right.
Let me ask you this, Jack. If when you look out there and see what's happening in the industry now that you are very formative of, what would you like to change? What do you see that you don't like and you wish you could change?
Well, the first, I have a long list.
I know you do. I
thought you might.
But let me, this is a little subtle thing that most people haven't even thought about. And that is going back to about 1958. The mutual fund industry I came into before then was like relatively small private firms, private partners, most of whom had investment credentials. And they provided an average return. Of course they did. But they were more or less like an S&P market index. They were all kind of clustered, and some would do a little bit better for a while, a little bit worse. But in general, and the prices the costs then were much lower than they are now. Believe that or not, the industry goes from $2.5 billion when I wrote my senior thesis at Princeton to $15 trillion. And the expense ratio of the average equity fund has gone from, in round numbers, 0.50 to 0.100, 1.00. It's gone up 5 times, in spite of the fact the industry, you can imagine what that does to management fees. So other investors out there, often foreign conglomerates, banks and so on, want to get on the gravy train. So they buy these management companies, and they buy them from the owners, or they take an owner takes his public, and then the outside guy comes in and takes it over. And they are in this business in classic capitalism, and that is they want to earn a return on their investment. So if they pay $1 billion for a mutual fund complex, they're going to take $200 million a year out of that complex. Come hook or come crook. It's an easy business to generate more or less cash. So they're going to take that money out. That's their first priority. Capture the return on their own capital. Their second priority is to have, I admit this, is to earn a good return on the investor's capital, the mutual fund investor's capital.
Right.
But you've got the shareholders of the management company over here with a complete conflict of interest from the shareholders of the mutual fund over here,
Right.
which always gets me to cite the Bible, always a good place to go. No man can serve 2 masters. And as the Bible goes on to say, you probably know all this, for he will either hate the one, and love the other one, and hate the one or love the other, and love the other. And the one that gets the love here is the one that's paying everybody bills, which is, of course, the management company. Right. So the management company is in control. It's working for a different party than the fund shareholders would like. And eventually, that is a conflict of interest that is irreconcilable. And that has to be banned. There should not be outside ownership. And eventually, competition, which is not so much on the cost side right now in this industry, competition should force other people to carry a mutual structure like we do. It's an essential financial service. You could call it a utility, and it ought to be offered at cost.
Is that clear, Rich?
Sorry about that.
No. I think it is, and as I say, your message is clear. And again, I really respect it, and it's don't get caught up in the latest fads. Don't pay 80 times earnings. Don't go for some hot stock. Just do your due diligence, find good investments, and give them a chance to grow. Yep. And I would say, corporate earnings drive the market because people will say, well, there's this happening in Russia and this happening here. Yes, and the market might go up down 100 points. We're long-term investors, and we want to give these good companies a lot of time to grow. And I mean, that's your message, and it goes out loud and clear.
Someone that has a 401k thrift plan.
Yeah.
I say, everybody's going to tell you it's very boring knowing an index fund because you know what happens. Every day, whatever the market does, it will do. good or bad. I should emphasize. And so never open your 401k statement along the way. And when you retire at age 85, or whenever you choose to retire, then you can peek
And see how you do.
and open your statement.
Right.
And the one thing I can tell you to be sure to do is have a cardiologist standing by, because you're going to fall over when you
You'll
see
be
how much
amazed.
money you've accumulated. You can't imagine it if you don't look all those years. That's something that people can't really do, but they ought to in a lot of ways. They ought to be conscious of that.
I hear you loud and clear because, I mean, truly, I mean, obviously I'm not in the no-load world. I get that. And I really think it's because people do need our helps in what you just said. You know, it is as simple as you lay it out, but for many people it's hard to do. You know,
Well, it is hard to do. It's hard. You have to first start by saving,
Yeah.
which involves a lot of discipline. It's, as people have been observing for a long, long time, it's simple, but it's not easy.
Yeah, that's true.
It's like dieting.
And not bailing out of the market.
Not bailing out,
After
not
you've
timing.
been hurt badly, and then,
Yeah.
March of '09, the market took off. It's up 170%, and
Yep.
there were people who got out at the bottom, and they're the ones who
Sure, I've letters from them.
will struggle forever.
Oh, yeah.
We did pretty well then. I hear, actually a couple of times already today, that people think, I mean, they tell me I saved their child's college education. Paul Samuelson, even the learned economist, used to say he owed more to me than I owed to him. He inspired me to start the index fund, really. And
Great comment.
and because he put as soon as the fund came out, he bought it for all of his children's education.
Terrific.
And, he knows what to do. He's a Nobel laureate. I don't think there's
Smart
a single
guy.
Nobel laureate,
Yeah.
including Gary Becker, who just recently died, who was a classmate of mine at Princeton. And he's an intellectual giant. I wasn't even in his shadow. And he agreed with me. He actually said my Princeton thesis, which was written on this subject, as I mentioned, was better than his. Well, it wasn't. I just heard that from one of his associates out in Chicago when Tom was dying a few days ago. So it's a lot of intellectual horsepower, and it works. Talk to a shareholder, and I talk to a lot of them, and I don't think I've had a single complaint on the index fund since it started.
Well, you have a lot to be proud of. We're glad you spent the time with us. I know our viewers were appreciative. Please come back. It's been a long time since you've been back, and don't wait so long next time. We do have a next guest. Our next guest is Mr. Joseph Dunn, who's a business author, most recently written After 100 Years, so please stay tuned for that. And I will tell you that Money Matters is now available as an audio podcast on iTunes and Stitcher Radio. It's listed as Money Matters, the podcast, for your mobile devices. And the video is also available on YouTube if you YouTube Money Matters. So as always, we thank you. But before we go, I want to personally be one of the first to wish you a very happy birthday.
1 day to go, and I'll be 85. Wow.
Happy birthday,
Thanks for your
sir.
time.
Thank you very much, Rich.
Happy birthday. Thank you, and your Money Matters.